Hi, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I'm Arjun Patsarthi. And in today's market highlights, the main topic will be the slice merger with the Northeast Small Finance Bank. And what is the regulatory changes impact on bondholders, which is becoming a very important subject, especially for bondholders of companies like Slice and issuers like Slice and many other such issuers. Before that, in the market, the 10-year gsec yields came down, largely following US Treasury yields drop, and the rupee was flat. Equity markets were better, but around the same levels, not too much of traction today. Back to the original topic, which you're talking about on Slice. Slice was in the credit card, it's a fintech company offering credit cards, and RBI came and said that the banks cannot give credit lines to Slice, and so Slice had to start looking for an alternative in terms of carrying out its business, and they had to get a banking license, but that would take a while. Hence, they went with this merger with Northeast Small Finance Bank. And we also seen that some of the large private equity investors in Slice have also taken a stake in Northeast Small Finance Bank, largely to facilitate this merger. But more importantly, what happens to the bondholders of Slice who have invested in Slice debt, the lenders of Slice and other stakeholders who have given them loans in various capacities, but more importantly for a platform like INR bonds that is into trading in bonds and enabling trading in bonds for investors. What is the impact of if they are holding bonds or Slice? The first is that clearly the credit risk is transferred to the new entity, and the new entity, they have to start looking at the financials of the new entity and what is the strength and can they support the acquisition, whether because of this acquisition would their own financials deteriorate. So too many issues. Clearly one is that rating agencies will put this on rating watch. The second is that there won't be any buying and selling, so liquidity will be completely zero for bondholders. And the third is credit risk gets either amplified or maybe stable, even better, but that takes a while. We have seen a similar merger, not a similar merger in some in a sense. Ujjivan Financial Services got merged with Ujjivan Small Finance Bank, and that actually helped the Small Finance Bank in terms of equity. The equity value was higher as investors saw better traction in this, and the bondholders of Ujjivan Financial Services are better off having the credit risk of Ujjivan Small Finance Bank, largely because of the fact that the SFB is regulated by RBI. Not that the bank financials is anyway reflect the fact that it's a bank, but perception-wise, given that it's a regulated entity, and if the bond is not one of those bonds like the tier 1 bonds, basic structures, then this gets this one bondholders can get a feeling that they're better off, and maybe markets have a better sense of better risk perception on the bonds of Ujjivan Financial Services. But coming back to Slice, clearly too many issues, and clearly bondholders will have to live with the fact that they have to hold the bonds to maturity, and they take in the meanwhile they have to keep watching out what's the kind of credit risk implementation. So primarily investors, financial advisors advising the bonds for their clients or bond products will have to factor in the fact that the issuers and what is the regulatory risk for an issuer, whether the changes in regulations can affect their business, we have seen a lot of regulatory changes on fintech, especially on the lending side of the business. And so many of the issuers who have come who have started business before regulations and have built up quite a traction before regulations came and changed their whole business model. Bondholders will have to evaluate the whole impact of potential or current or potential regulatory changes before investing in bonds, and also price the risk accordingly. That's the takeaway. And financial advisors are best positioned for investments on through INR bonds portal for the clients. See the best bonds, transparency in prices, information, the correct perception of risk, all that is available for advisors, giving the best options for their clients with the best investment process. And for curated list of bonds, Quick Invest app on iOS and Android gives a list of bonds that can be invested for investors and advisors alike, with very easier decision making in terms of information and price discovery, and easiest of in-app investment processes. Thank you very much for listening in, and do follow us on the YouTube channel if you've not done so already.
Attention financial advisors. Want to attract new business and customers? Offering a new asset class is the key. With debt mutual funds and MLDs losing their tax advantages, your clients need to diversify fast. Look no further than corporate bonds, the perfect solution for safety and good returns. Partner with INR Bonds for expert guidance and valuable resources to get started. Access a wide range of bonds on our portal and manage your client investments with ease. Visit partners.inrbonds.com today and unlock new business potential.